If you bank on this quite heavily, this can mean the difference between having stellar growth, going on unicorn path, raising from great VCs, and basically going for a second tire type of strategy.
Back to another episode of Go-to-Market Excellence. Joining the show today is Arthur Nobel. He is principal at Knight Capital, a European investment firm focused on scaling B2B SaaS companies, with particular expertise in helping their portfolio companies with go-to-market strategy and execution. Arthur, welcome to the show. We're so glad to have you.
Thanks a lot for having me, Dan. Looking forward for this conversation.
So, Arthur, you're not only an investor, but you're also an author. And you recently published Leaders of Growth, and I know it's on Amazon. I'm excited to read it myself. Tell us what the book is, why you wrote it, and maybe something unexpected that you learned while writing it.
Yeah, no, I'm happy to. So, me and the co-authors were all former founders. So we've gone through the struggles ourselves, and of course, in our portfolio, we see many companies struggling who are usually in the Series A to C stage. And when we started researching sort of like the broader market, we figured out that only 7% of the companies that raise a seed round actually raise a Series C. So apparently we see this big problem that getting from A to C or 1 to 25 million euros annual revenue is apparently very hard. And then we started digging in why is that? And we figured out that one of the drivers for that, we believe, is that there is a lot of content on product market fit. And there is a lot of content on getting super successful. Let's say the founder of Slack sharing his story on how he got to that point. But there isn't a lot of content in between. So that's what we try to address with the book. So what we did is that we interviewed 47 leaders who have a lot of expertise themselves on how to navigate across Series A to C. And we bundled their perspectives in the book. So just to make it a bit more tangible, people that we interviewed were, for instance, Jacco van der Kooi, Mark Roberts from HubSpot, Bill Makaitis, former CRO of Slack, and the former CRO of, the current CRO actually of Divi, Sterling Snow. And if there was one thing that really surprised me in this journey, is that people really like to pay back and share with the community, and that they're so open to contribute, and they were down to earth, approachable, and it was actually very pleasant to work with them. And that's sort of something I really look up for people who become super successful, that they have this type of mindset, and that reminds you always to do the same if people ask you.
That's great. You certainly have some heavy hitters in there. I know Jacco wrote the book Science of SaaS-based Sales, or I can't remember the name of it. I think it was The Science of SaaS Sales or something like that. I read it a couple years ago. Great book. And then you got Divi and the founder of Slack, you said, in there as well.
The CRO of Slack, yeah, indeed.
Bill Makaitis. Very cool. Very cool. So what's one thing, like if you're who's the book for? Revenue leaders, I'm guessing, or CEOs? Who do you have in mind when you're writing the book?
It's quite broad. I would definitely say the C-suite of a startup who is in the Series seed to Series C stage. So seed, one person's preparing for. Series A to C for the ones who are in that journey. Of course, you have the general enthusiasts, but also I would say the people that strive to be in the C-suite and like to have a bit more of this macro perspective on how to scale a company.
Mm-hmm. Very cool. So obviously, one of the big important things that comes with your go-to-market expertise is also advising your portfolio companies on how to go about go-to-market strategy, go-to-market planning, and things like that. One of the things we talked about that I thought was super interesting in our first meeting was you referred to it as the danger of spreadsheet sales. You talked about how so many companies make all these predictions, they put plans together, whether they be detailed plans or very high-level plans, but so much of it is based on projections, and not a whole lot of reality is based in them oftentimes. Explain what you mean by dangers of spreadsheet sales, and what that is and where you see it go wrong.
Yeah, obviously. What I evaluate companies like every day. Basically, I take huge joy in doing so. And I mean, the biggest part at some point is also like where it's about the future of the company, and then of course part of that is the financial forecast. And then, of course, you start looking into things like, okay, so how is future sales being realized? And then you get into like, and I would say the problem of forecasting. And what you sort of see is that metrics like the MRR close per rep, or assumptions like average deal size, conversion rates, churn rates, upsell rates, they are, let's say, projected a bit in an optimistic way. And let's say over 12 to 36 months, they increase gradually. But if you compare them to the metrics of today, it's actually quite a big delta. And also, in addition, sometimes I see finance leaders forgetting to include ramp-up times, or making basically the ramp-up times too short. So this brings down to a situation that founders and the finance
ramp up times for salespeople. Is that what you're referring to?
Yeah, correctly, yeah, exactly. How long does it take to get basically fully productive, like at 100% rate? Mm-hmm. So basically, what we see there is that founders in the end get over optimistic, and that the assumptions don't work out. And of course, you want to figure this out, so it takes like at least one quarter to figure that out, and then you have sort of this gap in sales capacity because the people don't perform as well as projected. And then of course you have to overcome this gap by hiring more salespeople. But then you get into into the situation that it takes, let's say, 2 months to find, if you're lucky, to find like great sales talent. Then it takes 4 months to onboard them. Then of course it took you at least like a quarter to figure it out. So in total, it takes you between 6 and 9 months before you have compensated this. And if you bank on this quite heavily, this can mean the difference between having stellar growth, going on unicorn path, raising from great VCs, and basically going for a second tire type of strategy. And especially in enterprise sales, this is a problem, because like I would say SMB sales, it's much easier to deal with it. But this is something that especially enterprise and mid-market type of startups should take into account. And my general advice is just take the actual performance, and if they then perform better, and use some benchmarks on, for instance, ramp-up times, and if they then perform better than planned, that's great, you grow faster, but you safeguard yourself.
Yeah, that seems reasonable. Let's get back to the foundational problem. Why do so many companies make such aggressive projections? Is they're making those projections and then they're presenting that to you as an investor or board member, and they want to, they're always looking with rosy-colored goggles, and they want you to invest in this dream? Or because what you're saying is basically, it almost looks worse if they have these incredible growth projections if they're not based in reality. That almost looks worse on the company than if they had slower growth projections but they were more based in reality. But foundationally, where do you think it goes wrong?
So just to make sure, the overall top line growth of a company can be super aggressive. I'm fine with it. I love it. I think just as any investor, as long as it has some realism in it. It's problematic mostly on the input variables, the output of what sales delivers. And I generally feel that founders and the broader, let's say the fundraising team, looks back and says like, hey, we saw this improvement, and they expect this linear improvement. And I do always believe that they are sincere about it, and it's not just to sell me something. And to be honest, if you become an entrepreneur and go on this startup journey, that there's at least 90% chance that you don't survive. So you have to be optimistic, right? So it's the nature of the game. So I think it's sometimes just important as an investor to have this open discussion about realism, and by that sort of together help make a realistic forecast and go there. Which doesn't mean necessarily that the top line growth rate should change. It only sometimes means that the funding ask gets bigger because you need more people to realize the same goal.
Who is often responsible? Who in your experience has been responsible for making these plans, and how does that evolve from seed stage to A, B, and C? Where you ultimately want to take these companies.
So what I generally see is that in a seed stage company, it's the founder. If you go to Series A, it's I would say the CEO is still quite heavily involved for sure about the overall process. There is quite often, I would say, a controller type of person that can be VP of finance, some call it a CFO, or sometimes even external advisor. But generally speaking, I would say in normal business terms, it's a business controller that supports them. And then if you go Series B and onwards, you definitely have, I would say, like a CFO or VP of finance director that is making the projections. And of course, founders always have, as I would say, every functional head in the organization is involved in the assumptions that are laid out in the financial forecast.
Yeah, for sure. And tell me, so I'm sure you deal with companies who are really detailed, companies who are not so detailed, not so good at the whole planning process. What do you think is the biggest difference? Explain the difference between those two companies and what they look like from your perspective.
So what I often see is that companies take a top-down perspective on it, and the really great companies, they have more like a bottoms-up approach and really know well and say like, okay, so if revenue is the output, so what is the input in this sort of lagging variable? So what are basically the leading indicators, and how do I influence each and every variable? Usually those companies have measured those variables over time. And are therefore able to make at least some sort of projections. Because let's make clear, I always know that a forecast is never going to be met. It's more something about the logic behind it, so that you have comfort about where it's going, in all honesty. And maybe it would be nice just to explain a bit of the difference between what I would recommend for SMBs and what for enterprise. So
yeah, I would love to hear it.
Yeah, so because this answer on what you asked is quite different, so there's nuance, I would say, is important. Because if you have like high velocity sales, which of course correlates highly with your annual contract value, that really depends on how you forecast sales. So what I just said on bottoms up approach, I see that mostly working for SMB type of companies. They have lots of customers in there, so there's some predictability. It's important to know that I'm coming here from the Series A to B type of stage as a reference. So let's say less than 5 million ARR. So in such states, for an SMB company, I would expect bottom-up metrics like funnel conversion rates, for instance, like leads, conversion to opportunities, conversion to the won rate, your ACV, divided by the number of people per rep. That's basically those type of metrics I expect to see in a forecast, and from there the people start extrapolating. However, if you look to an enterprise type of business, before you have 5 million ARR and you have, let's say, 100k ACV type of tickets, as you said your company is also into, it's very hard to basically do it, because you don't have so many companies, so many customers, and some has like 500k ACV deals, some are 50, so it's much harder. So in that case,
not that much data. Yeah, there's not that much data to measure in the past, and not much historical, and it's tough to project.
Yeah, exactly. So then I would usually not go about predicting number of leads, conversion rates, etc., because those are usually going to be off, and one deal of 500k can make up like a lot for a lot of misses in conversion rate. So in that case, I would focus on, let's say, what's the quota of a sales rep, and what's that basically the attainment percentage, and would use that as an input for sales. And once you hit, let's say, the 5 million ARR bracket, and things start getting more predictable, you focus more on a bottoms up approach. And the reason why that's important to switch is because you start as a whole organization, start having a focus on like what are the leading indicators to drive my sales. So you know, like, okay, this is a marketing job, that's a customer success job, that's a sales job, and that's the SDR job. From there, you know, you have this company-wide focus.
Yeah, for sure. So you're saying that even in an enterprise organization, once you cross the 5 million ARR threshold, that you do see the best companies starting to build a bottoms-up approach, even if they're heavily leading on enterprise salespeople?
Yeah, I would say so. Of course, there are exceptions, but generally speaking, that's definitely the case. Because, I mean, if you do like quota times attainment rate, that's focused on account executives. But of course, you also have to focus on all the leads that have to be created, like top of funnel. And for that, you know, you also need to have like a sort of like a bottom up approach on how you realize that. And I think that's important.
How could somebody who's trying to build a bottoms-up plan get it wrong?
Get it wrong. Of course, you have the over-optimistic assumptions as we discussed previously. Then another thing is, for instance, like what I said about the ramp-up times, that you don't have them or make them too short. Another thing I look quite.
Yeah, let's talk about that for a sec. The ramp-up times. So explain step by step what you're referring to there, and because I think a lot of companies, they make really aggressive plans for, okay, we need 4 salespeople, but we need them now. But the reality is, like you said earlier, it's really 6 months until they're productive. Why do so many people miss that?
I don't know. I feel that some of the, someone with a business background with years of experience shouldn't miss it. that's a very bad signal. But if you, let's say, have a developer background, I totally understand. If you're very strong in building a product, you're a CEO, maybe this is the first time that you actually have to think about these things, and you're very capable, but maybe this is something you didn't know and you didn't have the revenue leader yet in the company. So that's like an easy mistake to make. And I also sometimes think that if people are like fully into the product, they think like, yeah, you know, we just make some manuals here and there. They have all the contextual information. So it seems very logical that someone is fully ramped up in 2 months. The truth to be told here is that it's usually between 4 and 6 months, according to the benchmarks.
Mm-hmm. And so if you're building a ramping plan, what are the different variables that you include in the ramping plan?
So
because I'm assuming, you have to, obviously the time factor, but there's also the failure rate of a sale. Not every salesperson makes it. And what are some of the other variables to consider?
Yeah, it's a very good question actually. So to focus first on this time scale. So let's say you expect, for instance, a 4 months ramp period. Then if the quota is, let's say, X, then first month they hit 0, second month maybe also 0, third month 25, third month 50, and last month basically they make it up to 100%. So that's like a variable to play with. This is really specific to your business, so you can't really say this is how you should do it. And of course you can play with that. Another thing indeed, like
sure.
How many salespeople you should need, and how many basically go wrong. That is really data that you have to build over time. So it's quite hard. I know there's a lot of debate on hiring 2 sales reps when you only need 1. This is especially from a moral point of view, that sometimes can be a discussion. I would be in favor of still applying that, because especially in an enterprise context, you don't have the time basically to after 4 months to start with the hiring process all over again. So I would apply that, and maybe in the beginning just go expect a failure rate of, let's say, 50%. And something which I really liked from, I told you about the book that I had written, and I got their input from Mark Roberge, and what he was saying, which I really liked. He said, like, okay, first you need to get product market fit. At some point you need to have go to market fit, and from there you start scaling. And once you start scaling, and this scaling can already be, let's say, from 1 million AR plus. And what Mark suggested was saying, like, okay, every month for the first 6 months you hire 2 new sales reps, and you basically see how they start performing. Then after the first 6 months you hire 4, and if that works out, afterwards you start doing like 8. And this has multiple advantages. But one of them, which I really liked, is that he said, like, if you're continuously hiring, you build talent pools, and you can get talent out of the market at any point in time. And I think that is really strong to safeguard yourself if a hire doesn't work out. And that is, I would say, a much better approach than what we see often. Like, you raise money, and then you hire a lot of salespeople, and then you wait for, like, basically the next raise, and you do it sort of again. And I think that would be my 2 cents.
Yeah, that's good. That's good insight. And the other thing that people do is they build a sales ramp up plan, and they do it in a vacuum, not considering the leads that are needed to support those salespeople. And this is maybe more common in SMB as opposed to enterprise, where people are doing a lot of self-sourcing, self-generating business. But in SMB, I mean, if you're going to hire 6-7 salespeople after raising money, you damn well better have the leads to support them, and so they're not just sitting around. Have you seen that cost companies a ton of money as well?
What I often see, that is definitely a mistake that I've seen, but the more frequent mistake is that I see is that, let's say, going from 25k MR to 100k MR it's not easy, but it's definitely doable. So usually I see 2-3x growth rates at the very least. But then once you hit like this 100k mark, and you want to grow to 300k in a year, or even more, then it starts getting quite challenging, and that's usually because top of the funnel of leads is not really there. So if you have a problem down there in the funnel and you have salespeople and it doesn't really work out, that's usually quite easy to fix. But getting a lot of demand inflow, that is the big challenge for that companies have, and that's can be a hiring aspect, but most of all it's I would say it's also partially a marketing challenge. Or sometimes there can be many challenges, of course. It can be like urgency thing, can be a marketing thing, and a few more.
Absolutely is. That's why if you think about it as one revenue team as opposed to just these sales and marketing silos, then you actually think about the full picture. You're thinking about, okay, we want to hire 2 salespeople. What money do we need to put into top of funnel to generate enough leads for them, and so on and so on. But if you do them in a vacuum, if you plan separately for your investments in marketing and sales, then you get out of balance. Maybe you're getting a ton of leads, but you don't have the pipeline of salespeople to come in and follow up with them.
Absolutely.
Or maybe, yeah. Well, any addition to that?
Some of the things what I initially thought back in the days as a founder is that that this problem would mostly occur in the beginning of a startup, and I thought then you tackle it and you never have this problem again. Well, as you just described, what I learned from, for instance, Ray Reich in the book is that he said that it usually happens later on in the journey. So let's say you're 10 million ARR and you raise like a massive round and you have to scale like crazy. And sort of like everyone has their job, like marketing, you have to fix this, sales, you have to do that. And then people start getting more in sort of in functional silos, because they're very high targets. It's very busy. And the teams also have gotten larger too, so that it's easier to get siloed. And that is something that many startups should be aware of. That you never have to be like a siloed organization, and don't focus on that only in the beginning, but particularly once you get larger.
Mm-hmm. Yeah, that's so good. Let's switch gears a little bit and start talking about funnels. We started, I mean, obviously planning, when you're talking about planning and a bottoms up approach, you're talking about what investments you're going to make to fill your funnel and the different strategies that you can invest your sales and marketing dollars in. I know you've said in the past that a lot of sales and marketing leaders are good executors and not necessarily good strategists. And you're big on the funnel. So give me your view on the funnel, why it's so important to think from a funnel mindset, and where this works best and where it doesn't work so well.
So maybe it's nice to share. Like, I was sort of quite influenced by my funnel thinking by, on the one hand, by Russell Brunson from Clickfunnels, and on the other hand, you have this pirate metrics funnel model from Dave McClure. I sort of created my own models with that and started combining that. And one of the things that I often see is that companies sort of lack like a strong, structured, and organized funnel. So something is working, and there are different pieces to it, but there is no sort of like macro perspective on saying like, okay, I have different stages of a funnel. So like to go to this pirate metrics funnel, you have like awareness, acquisition, activation, revenue, retention, and referral. That's the funnel. Then of course, you want to align it with the customer journey, and then you bring in that perspective from Russell Brunson. That he has like different building blocks for like a funnel. So just to give like some examples of some building blocks are, for instance, automated webinars, email series, free books, live webinars, and there are like a ton more, free quizzes, whatever. And you sort of start placing these building blocks on the different parts in your funnel with one clear persona, clear messaging, and then you have sort of one funnel that is working, and you start identifying like, okay, where does it work, where doesn't it work, and how does that compare to at this point is that I feel that there's not a lot of orchestration behind it. For instance, if you look to Russell Brunson, he has like this micro commitment. So he has it like a stairs, like, and every step on the stair is like a micro commitment. So and if you design that really well, I do think that you can increase your conversion rates much more. And that is something that I don't see a lot of companies in Series A and Series B stage have in place. So it's a bit like all over the place and not so well organized.
I want to stop you there because that's pretty interesting. Let's dive into the stairs and the micro conversion points. Maybe you could give an example of like a company you have in mind, even if it's not a real company, but like the size of company, the ACV, and then like an example. I know you gave a few examples, but let's pick one and really drill down on it.
Let's do so. Let's take just Clickfunnels as an example, since they're also a SaaS company, and obviously I'm not in the company or not affiliated to the company, but as a customer back in the days, what they did, so they had like community groups on Facebook, or they had like ads. So that was basically the way to make me aware and acquire me basically on the website. Then I got on a website which was called .com Secrets, which was basically a website with lots of social proof, explaining basically how you can grow a lot with funnels. And there was like a free book that Russell was providing. So you bought the book for free, and then you got sort of, that was like the first step. It's sort of like activation.
Was this an ebook or like
a physical book?
A book that was mailed to you?
He did like a physical book. But and I think he did that because of sort of like a growth hack that he applied, but you could also do like an ebook. But that once I sort of entered his funnel, I got sort of like other type of offers. So I could, for instance, get like a cheap course at a very reduced price, or I could join like a webinar. And once I basically decided to do or not do that, then I sort of entered in his email series, and he sort of dragged me into this Clickfunnels world, where I started to learn a lot about the topic that I wanted, which was sort of growing my website. And then at some point, you basically schedule a demo, or in the Clickfunnels example, you just go to the website, you basically register for the free trial of Clickfunnels for I think it was 7 or 30 days, and then you start paying afterwards like €300 a month, so something like that. So that's like a ticket size of, let's say, around $5,000 a year, and that is sort of how he got sort of into this funnel. But then afterwards, he started monetizing more with like upsells, and he had these whole conferences with lots of tickets around it, and again providing you lots of content on how to succeed. And the essential thing what he did, what I sort of learned from him in a way, is that he said, like, so there is this problem which you're sort of solving, and you solve that in different formats. So let's say you start with maybe the most scalable thing, and when someone actually has bought a book and is sort of in need for more, you basically present him like the next option, which is a bit more expensive, a bit more elaborate, and you go up the stairs. And the interesting thing is what he tries to do with the first offer is just to have like a payback time of 0 months. So he just gets the money back. So he has like a free customer. He also didn't make any money on it. But from there, he starts trying to upsell you in the real products. But he therefore got leads for free. And I think that is a very interesting model, which I haven't seen broadly applied with startups.
How would the lead be a free lead? If I know the book obviously costs money to make upfront, getting somebody to download it or purchase it for $0 is acquiring a lead, right? That wouldn't necessarily be a $0 cost of acquisition for a customer. It's not a customer yet. So what do you mean by that?
I mean, in his case, he is serving, let's say, small business owners. So let's say the SMB segment. And once you get into the book, you get this one-time offer for which, let's say, 30% converts. So he always has basically the money back with the immediate upsell that he provides to buyers in need. And also in his case, I think he has the book, so he sort of gets money back through like an affiliate link from Amazon. But this is something I don't know for sure. So I would say this strategy applies for the SMB segment. An enterprise segment is different, but I would say there is still quite a lot to learn from this approach.
Yeah, it certainly is. And what do people do? The people who aren't thinking about funnels and building every step of micro conversion, what are they doing, and what are they doing? That's where are they going wrong, I guess?
I think you start a company, and this is my assumption, but you start, let's say you have like a problem, you think, oh cool, let's find the company, you interview people, and you figure out, hey, there's sort of product market fit. Then I usually start in the beginning by just picking up the phone, or you start just doing ads, and you get people into the door. And from there, you sort of start scaling that up, but there is not this really systematic approach to building a funnel and thinking in blocks, and basically making that work a lot across the customer journey. And why that's the case, I do think it's a matter of time, because generally speaking, very busy. Second, I do not always think the knowledge is available. And thirdly, this is something that would be ambiguous. I don't know if there is also the Clickfunnels community and a lot of other freelancers around it. They're basically bootstrapped, right? So they have to make like lots of they have to earn basically their money back very quickly. And I think that also makes them creative. And capital can sometimes maybe make it a bit more lazy. Not every founder is that frugal. So of course, I'm not blaming someone here, but this could be a potential cause as well.
Yeah, and so you just run the plays that you see other successful companies running instead of, and you, for example, I've been in the inbound marketing world for since 2012 or 13. Had just heard of Russell Brunson and Clickfunnels this year. these are very close cousins, the inbound marketing world and the Clickfunnels internet marketing world. You know what I mean? But it almost seems like there should be more overlap, but there's not. You know, you're either running inbound marketing, you're running account-based marketing, or but the people who get all of that and more are the people who do internet marketing, and they're having to write killer sales landing pages, and they're having to run ads and make their money back within 15, 20 days. So I'm super interested that there's not more overlap between the kind of, I guess it's like more hustling. The ClickFunnels ecosystem is more hustling, and then there's the VC-backed world, which seems to not even think about that or views it as spammy. ClickFunnels world as like a little bit spammy.
Yeah, I would definitely say so. Some would say so, and I've definitely seen cases that I would subscribe to that idea. But what I always try to do, which I think they've done as well, I think they got their inspiration from people selling on television, saying like, this is this unique watch that you should buy right now. And basically, all the scammy stories from TV.
Infomercials.
Exactly.
Yeah.
And from there, they developed into this. And what I just try to see more like, for instance, the micro commitment strategy, or thinking like the building blocks, or seeing the similarity in sales funnels if you have a certain ACV, and use that guiding thought, like have upsell thing offers in the heat of the moment, that are sort of like constructs that I just try to use in a different environment to still make it work, and that's how it's an inspiration for me.
Yeah. All right. Let's talk about how to apply some of those principles to more of an enterprise company. And I'm not talking like $1 million deals. I'm talking about more like 100K ACV. The type of deal that you're not going to see a whole lot of companies selling those, taking payments online for $100,000 platform. Typically, that's like maybe around 10,000 ACV is you can get people to pay up front or pay online. But for the companies that are like 100,000 and over, what are some of the principles that maybe you've seen some companies that are applying ClickFunnel principles? Or maybe you haven't, but you have some advice for those companies.
Yeah, so what I generally see in enterprise environments, there's definitely a difference in selling to freelancers, and I think there are some limits, or some limitations of the model. But I see like Microsoft research, for instance, shows that you need 7 to 13 touch points basically before someone buys something from you. So if you do like high ticket sales, it's not just the AE going after and trying basically to make calls, etc. It's also really about sort of laying out the overall customer journey, aligning your sales process to that. Then of course aligning that with your sales department, marketing department, customer success department. And how I generally within that model connected with the sort of ClickFunnels example that we described, is that I'm a big believer in a couple of things. First, that you can like innovate on the offers. So if you have like 100K ACV deal, can you also do something for like 1,000 or for 10,000, which is like on a bit more like highly automated sequence, so that you can get like leads in the door, which you like can later on upsell in a more I would say in a scalable fashion. So that is one that's on the offer side. On the more on the acquisition side, it's really about building. Let's say you take the email as an example, and you build all these touch points around this email, and having like a very structured approach to saying like, okay, this person is here and there in the customer journey. I have this and this touch point, which is for instance the email, and I'm going to target this lead with this proactively and reactively with this type of, let's say, ad, automated webinar, sales call, etc. Just be and then convert them like into this deal. That's of course like an account-based marketing or sales principle, which I think that does work really well.
I think your idea about leading with a book is also a great example for enterprise, because if you're selling a higher ticket item, you often are trying to um, you're trying to change people's minds from where they currently are to something. People don't always know that they need a product that might be more expensive, or an enterprise product, or a product and service combination. So having a book being being the first offer that somebody comes across, not only is it free for them and adds value immediately, but it starts to ingrain them into your views. I mean, I mentioned Jacco Vanderkruij's book earlier, or on in a conversation today, but that's a perfect example. I saw his science-based sales book, and I read that 2 years ago, and when the time is right, I'd love to hire Winning by Design, because, and of course there's other touches. I've seen them on G2 Crowd, and they're highly rated on there. I've visited their website, and I've seen them on there. But it's the book was the starting point for me, and I think that would be a great model for anyone in a consulting business or in a higher ticket SaaS platform.
Yeah, exactly. And it's really about converting to 100K is like a big step. So are there some sort of scalable, smaller steps that you can add in between, but don't cost you a lot of money, so that you sort of basically get this type of free leads? And also with this micro commitment, figure out where is someone in the customer journey, so that you can build like lots of touch points around that specific step. And I think that is really, a key, and that's also where the building blocks come in. Like a building block would be like the webinar, would be the retargeting email, would be the whatever.
Mm-hmm. Do you have any companies that you guys are so when companies come and pitch to Knight Capital, is one of the things that you're looking out for? Do they have at least one funnel set up that's running and creating customers efficiently? Is that something that you're always on the lookout when you have Series Seed or Series A companies coming to you? Like, what do they need to have going on from a funnel perspective for you to get excited?
I generally tend to look it starts with if you only look on the acquisition dynamic side, of course, at first look like high over, does it work? Do they grow a lot? 1 month over month, basically like the lagging variables. Then start looking in the input variables. Do I see, for instance, like lead velocity growing? Do I see opportunity velocity growing? Do I see ACV growing? Do I see basically non-founder sales, or not too much concentration in certain aspects? Do you see sales cycle shortening? And there are like lots of metrics that you can look into. If I see that's generally improving, if I believe there is product market fit, that multiple people can sell the deal, I would typically say like, okay, there's like a replicable sales model. It's maybe not predictable yet, but at least it's replicable, and the team knows how to influence the critical drivers in the sales funnel. Then we can optimize all the rest afterwards. And the core is there, because if you know the theory and start applying it, everything I just said is not very difficult. You have to know it and how to apply it. So that's generally how I look to it. See more of sort of like a go-to-market fit. Yeah,
and certainly to put a go-to-market motion in, like you're talking about with these funnels, you need a properly architected technology stack. Even the metrics you were just talking about that you're looking at, all the conversion rate metrics, the sales cycle metrics. That stuff doesn't just appear out of thin air. You need these portfolio companies to have properly set up the tech stack. And I guess what percentage of companies that you look at are you able to see with confidence what their whole funnel conversion path looks like, and I guess which percent are you like, man, this is a mess?
If I would rephrase the question, like how many companies know how to drive their specific funnel metrics and can explain to me like, okay, we're going to grow this 3x over the 12 months because we do this and this is what we did before. Less than 10%. I don't know the exact percentage. From the ones we speak to. From the ones we speak to, maybe even less.
Would you pay more for the companies who had a really sharp handle on their data?
100%. 100%. Because that's the interesting thing, because then you start talking about valuation. So let's say I pay, in the past, maybe 10x was like a fair rate in Europe, 10x multiple on the revenue. I think nowadays, it varies a lot. I would say like the average public multiple is like around 16 or 17. For SaaS companies, but of course, metrics, performance, as well as some other factors influence your performance. But if I pay, let's say, 15x, 10x, or 25 or 35x for a company, then I basically pay for the future potential of a company. And knowing a company that gives me more assurance that they can realize this future potential justifies me the valuation much more, because if I only look to the past, to base my valuation on, then I basically might pay a very high price. So I need to give some confidence that what I did in the past will also happen in the future.
Mm-hmm. Wow, that's super interesting. I mean, the dichotomy between your point of view that yes, we will pay a higher valuation for a company that is really knows the levers of business and knows their metrics, and then the dichotomy between that and it's only 10% or it's only 10, even if it's 20%, that's an incredibly low number of companies who have a tight handle on their data. All right, let's get to the one last thing I wanted to go over with you today is the whole idea of product market fit. And you've alluded to it a couple times that that's one of the foundational things you need. No one would argue with that. But you have a different take on it. And why don't you tell the audience what that is?
Yeah, so if I would make like a big statement, is that I don't believe in product market fit. And I would definitely go as far as to say, like, hey, you build a company from scratch, then you have you find a problem, then you have a solution for a specific use case for a certain persona, and then that works. And you get some revenue. Okay, maybe we could call that product market fit, and maybe that's sort of the first product market fit. So because it's the first, it's the most often talked about. However, if you want to grow really big and grow, let's say, 100 million exit, IPO level type of companies, if that's your horizon, then of course, to grow bigger, you have to basically diversify in the geographies that you target, the customer segments that you're in, and customer segments referring, for instance, to SMB, mid-market, enterprise, the different industries that you're in, etc. And if you, for instance, go from the US to Europe, like succeeding with that internationalization, that is already like a product market fit in itself. And the same goes if you start selling to SMB compared to, for instance, serving first only the mid-market. And that is so how I look to a company that just IPO'd. They might have gone through like 1,000 or more product market fits. So it's just not fair to just think only like linear about it, and so see it sequential, because it's not sequential. It's a continuous returning problem that you have to solve, and that's why scaling is so incredibly hard.
I would add one word to that, and that is message fit too, because just like product market fit, you have to establish that whether you're going to a new geography or going up market, down market. But your message also changes too. I think you're including that in there, but it's product market and message fit. And do you have any companies that come to mind that I guess are aligned with you in that thinking that it's not just a one-time thing. We don't just establish one-time product market fit. We have to adjust it wherever as we scale.
Definitely. Maybe just one comment on the former is that maybe it's nice for the audience. Brian Bolfor, I think he has a great blog. I learn a lot from him. He has written a blog on different types of fits, like channel fit, market fit, ACV fit, different. I think that's interesting for the audience to read. It's one of the foundational points for me just to get to this insight. But just to return you to your question, what I generally see companies, the ability to scale basically is very largely dependent on, for instance, the generalizability of a market, and its size and the synergy with your current business. So just to give like an example related to that product market fit, I came from Rocket Internet, who built like several unicorns as an incubator. And what I saw, they were in the e-commerce and marketplace type of business. And those businesses very much rely on paid and organic search. Mm-hmm. But scaling that model in a way, there is definitely sort of like a playbook for it. It's quite generalizable across markets. So that's why, of course, they also had to adjust to some things. But that's why it was relatively easy to launch something in Germany as it was in the UK or in France. Because the approach was relatively similar. And I see that also with a company that we have in our portfolio called EmberScript. They do speech-to-text. Speech-to-text company, but more focused on subtitling in that sense. But sort of the need for that product is quite the same in Germany or in France. So it's relatively easy to expand geographically. And that is why for other companies, now they are much more localized, and that's why it's much more difficult to get product market fit in each and every aspect. So that's something you look to for as an investor, its ability to scale. Is it easy to enter different geographies, different customer segments, etc., etc.?
Yeah, so when you go from one nation to another in Europe, if you have the go-to-market model, are you saying the go-to-market model is easily transferable for EmberScript? Like you run the same ad targeting strategy. It's just you have to change the language, or you have to, update the marketing collateral and things like that to be languages and country specific. What else?
Yeah, exactly. That's generally what they do. Of course, they wouldn't agree with me that it's that easy, which I also agree with. But it's much different, for instance, compared to let's say Superb experience that's a guest experience software for restaurants. Selling in France to restaurants is much different than selling in the Nordics, just because even like the payment infrastructure for their POS is different. So that is So there are much higher country entry barriers.
Gotcha. I see what you mean. And I think I have to imagine that there's other factors too, right? Like having visited Spain, a lot of those restaurants take cash payments, whereas other countries maybe are more reliant on credit cards or whatever.
Exactly.
Is that something? Yeah, interesting.
Yeah. So the only thing, for instance, like with Superb, I do think they can internationalize well, and they've shown that already. I think that's one of the things why we got excited about it. But in such cases, you as an investor, you want to look like how big is the market. So, for instance, only if you win, let's say, the Nordics and Germany, you're already operating in a super big market. But you have also other startups, and I think for that audience, it's interesting that if they are operating in a relatively small market and they have to expand a lot across like countries, different size of businesses, the complexity increases substantially, and therefore it's very hard to succeed. And therefore, I'm not saying that it's impossible, that it's not possible, but it just gets much harder.
Yeah. Very interesting. And all right, so one last thing on this product market fit. If you're what advice would you give to somebody who wants to go away and say, I want to apply this advice on product market fit, that it's not just a one-time thing, but we need to constantly be evolving and iterating on our product market fit. What's the takeaway that you want somebody to walk away with from this episode?
Two things I learned in my book as well, which I ask people, is for sort of practical solutions to this problem. Like first, if you enter something, let's say new country, new industry, just apply 1.5 to 3x your sales cycle to test something out and to see if it works. So that is one. And second, start with, let's say, a SWAT team or just only a trailblazer person, because they can sort of navigate the paths and sort of can build the playbook. And the people that you have in your company that are just used to working by processes, they will have a hard time like expanding in a way. So picking the right people and having the right time to test something and dedicating sufficient resources is very important to make it work and get product market fits, and to say in these different verticals, customer segment, geographies, or also distribution channels.
That's super interesting. It reminds me of the book, I believe, Reid Hoffman's Masters of Scale, I think. And he talks about generally there are different types of people at a company. Some are, and they're good for different stages of a company. What you just said about sending people in who are more trailblazers or pioneers, he refers to those people that I believe is like the Marines. The Marine part of military force, and they go and they like make the first infiltration into the land, and then later on the infantry, the army comes, and then when it's all set up, then the Navy is like guarding the port, and they're more of like the, that's when you have your processes and everything's down. So even in a startup, you need different people for different stages, and I think that's what you were kind of talking about there.
Yeah, 100%. 100%.
Yeah. Well, Arthur, it's been really fun jamming with you here for about an hour, and I really appreciate your time. Thanks for coming on Go to Market Excellence. And if you're listening and you're interested in hearing more from Arthur, be sure to check out Leaders of Growth. It's available on Amazon, Arthur, and where else? Anywhere books are sold?
Yeah, exactly. I mean, very happy. Like in the first month, we became like a bestseller on Amazon, so I was quite pleased with that result. But also for people who are not really the reading type, they can just follow our podcast with a similar title on Spotify and all major channels as well.
Awesome. We'll be sure to check it out and subscribe. Thanks for coming on, Arthur, and we'll hope to catch up with you again down the road.
Thanks a lot, Dan, for providing this opportunity.